Please welcome the panel on Credit Investors Taking the Reins, moderated by Executive Vice President of Milken Institute Finance, Michael.
All right, welcome to the session on Credit Investors Taking the Reins. My name is Mike Piwowar. I'm the Executive Vice President of the Finance Pillar at the Milken Institute. I have the privilege of leading a great team that addresses challenges across the financial system to increase access to capital, savings, and investments, particularly for underserved individuals, businesses, and communities. One of the biggest trends that we are seeing is the increasing importance of private credit. Once considered an under-the-radar niche sector for non-investment grade or distressed companies, the private credit market is increasing in size and scope. Our panel of experts will show us how market participants are reshaping global credit markets. We will get their perspectives on where there are still opportunities to seize and how to mitigate downside risks. We'll learn what the future holds for the state of the credit markets worldwide. So let's get started by taking a trip across the world. Let's start with Asia, with Sandeep Chandak. Sandeep, as the Managing Director of Elham Credit Partners, you're providing credit solutions to corporate and private equity firms across Asia. Where are the biggest opportunities and risks in Asian credit markets, and how do they differ across the countries within Asia?
Right. Thanks, Mike. And Asia is a collection of markets, right? So we have to kind of decipher each market piece by piece. Of course, you have from Australia to Japan on one side, you have India, Indonesia, Singapore on the other side. As a collection of all these markets, Asia contributes almost 60% of the GDP growth of the global GDP growth, right? So that's a large market. We see the scale of opportunities to be really, really large there. So if I talk about the size of businesses which has been there over the last few years now, we have grown from what used to be $5 or $10 million EBITDA businesses to now what we look at $50 to $100 million EBITDA in our portfolio. And that tells you the evolution of the businesses there, and that's the kind of opportunity we are seeing now. Private credit on the other side is just still at the infancy of the market, right? So we are seeing very early stage of where the markets are. We are seeing very early stage of how the market is evolving, and we see that over the next 5 to 10 years, it's just the inflection point now, and we are going to see massive growth over the next few years or so. Now, one of the differentiating factors about Asia is we are not finding beta there, we are actually finding alpha. And that's because of the quality of businesses and lack of access to the credit markets, especially the private credit markets. Of course, the bank markets are fairly well evolved, but I think that's the biggest differentiating factors, the kind of structures we face in Asia, the leverage levels we face, the covenants we are able to put in the Asian deals is when we compare in the Western markets, it's very high quality transaction. So from our perspective, it's a really, really long-term opportunity set, and we see that all these large markets are going to give us, opportunity of deployment for the number of years to come.
Yeah, and where do you see the biggest risks?
From a risk perspective, of course, geopolitics impact the world. The risk for us is when people find more returns in the Western markets, whether the capital flows out of Asia or comes back to Asia. But the most interesting part right now is with where the geopolitics is today, Asia is where supply chain disruptions are happening, and that leads to more capital formation. So what is the risk right now from a global market standpoint isn't actually an opportunity for many countries in Asia, where it could be a China plus one strategy, or anything which is leading to more development of infrastructure or the development of manufacturing in many parts of the Asian region. So we see risk, which is there obviously globally. We face the same, and that will impact the currencies, that will impact the volatility, but we see that as an opportunity for Asia.
Great. So now let's go to the United States with Michael Gross and Zia Uddin. So Michael, you're the co-founder of SLR Capital Partners, which provides financing solutions for middle market companies in the United States. So the US in particular has seen a tremendous growth in private credit, particularly since the global financial crisis, filling in a pullback from bank lending. So give us your view of the state of the credit market in the US. What are the biggest opportunities? What are the biggest risks?
Yeah, I think the US is clearly the most mature private credit market, which is both good and bad depending on who you are. If you're looking to borrow money, that's a great thing, because there's so much more competition where you can borrow money much cheaper than you have historically. And if you're an investor, it may not be so good for you. I think the market has really evolved, and you hit on earlier about alpha. Private credit started coming out of the great financial crisis as all alpha. I would argue today that 80–90% of the market has evolved into a market of beta. Right. The market's become too efficient, which again is great for borrowers. But if you're in the private credit business or you invest in private credit and your strategy is lending to private equity-backed companies of 70 million to 200 million plus of EBITDA, you're chasing an efficient market. You're back into a market now that is driven by techno factors, meaning how much capital is flowing in and out of the market. And at times, cash flow lending may be a great place to invest because banks have pulled back, but other times it may not be. And what I mean by that is, last year, and frankly here at this conference, everyone's talking about the golden age of private credit. I would argue cynically that we had maybe the golden 3 or 4 months of private credit. There was a period of time when the commercial banks shut down, the CLO market closed, and if you were in private credit, you could have a field day. Why? Because you could lend to well-capitalized companies, levered 4 to 5.5 times, mature buyouts, and you get returns of 12 to 13% and actually get covenants. Fast forward to today, the market has reacted so quickly and efficiently to the influx of capital once the CLO market formation came back into play and banks got the backbone to re-underwrite loans, to the point that those loans that were being done a year ago at SOFR plus 650 went to 650 to 600 to 500. Now we're probably at 350 to 400. And so my big concern about the private credit markets of the US, if you don't have differentiated strategies beyond just cash flow, you are in an alpha product. And the bigger you are, the more likely that your returns are going to be consistent with public market returns as opposed to private market returns.
Great. So Zia, get your perspective on that, right? So you're the president of Monroe Capital. You also provide financing for middle market companies. Do you have the same perspective in terms of is it too efficient now? Or are we past the golden age?
Unfortunately, I have to agree with Michael. So what I would say is it's a tale of kind of different markets. If you look at the U.S. market, it's absolutely totally vended in terms of private credit. You have massive players of massive scale. I think the industry is going through a turning point where scale matters. It's an arms race for scale. So you see the big getting bigger. If you look at the fundraising stats, the top folks capture 80% of the fundraise, 50% of the fundraise. So where do you play in that space? So if you're entering into private credit in the United States, generally the upper end of the market is probably not the place I would start. And I obviously have a bias. Where we focus is the lower middle market. So think 35 million under EBITDA. Why? If you look at the U.S. economy, for those who don't know the U.S. as well as others, there's 200,000 companies that have revenues between 10 million and $1 billion, generates about $10 trillion in an economy. So if you ranked it in the world economy, it's the third or fourth, 48 million jobs. So that market is highly inefficient. So how do you take advantage of that? You need to, in my opinion, originate your product. And if you can originate your product, then you can dictate things like pricing, structure, covenants, leverage, all this stuff. The problem is people have different interpretations of origination. So some people say, hey, I'll call a desk, give me a piece of that deal. That's not what I'm talking about. What I'm talking about is you have to have a grassroots effort where you're talking to CFOs, iBankers, lawyers, wealth managers, and they're the ones that are in contact with these business owners. And the beauty of this market is there's always something going on, meaning there's buyout firms buying companies and trying to grow them. On the non-sponsor side, you've got folks, father selling to a son. There's a generational change. There's always refinancings happening. So there's a way to play in the seams, but in terms of kind of where to play, I think the beta play is last year's news or a few years' news ago, but I think there's still opportunity in the market. And pointing to what Michael said earlier, when you have double-digit returns and 0 losses, something's wrong. Like it's not sustainable. So something's going to give, and you're seeing some of that in the upper end of the market. So if you look at the upper end of the market, the BSL market, the historical recovery rates in that market were in the 60s, low 65, 68. Last year was 38. So something's starting to happen, and so we'll see where it all ends up.
All right, thanks. So Orla, let's now move to Europe.
Sure.
You're the managing director of Europe Private Credit at Barings. Financing in Europe is a much more bank-dominated place than the United States. Where is Europe compared to the US in terms of the development of private credit and the opportunities and risks that flow from that?
Yeah, sure. Well, not dissimilar to how you've sort of presented Asia. You know, Europe isn't a country. It's a collection of many different countries, each with their own tax jurisdiction, framework, etc. But much more than that, like very much different culturally in terms of how corporates operate and how they're required to operate. And so having that sort of local knowledge is imperative, and it really is important that you have that coverage point, and you mentioned origination, that deep sponsor relationships and beyond that sponsorship relations across the entire network. To where Europe is relative to the US, so Europe has always lagged somewhat behind the US, and I think for our advantage at this moment in time. So I think last 5-7 years, we've seen significant uptake driven by the bank retrenchment in the space, and we've seen a lot of players come into the market, some of them gaining scale, some of them around longer than others. Barings predominantly, you know, doing this, you know, institutionally for one of the longest in Europe. And in terms of sort of what we're seeing currently in terms of trends, so I would say less efficient than the US market, so slightly slower to react on that level, which we gain from a returns perspective. And also just the sort of that continual retrenchment of the banking sector, you know, given the regulatory framework that came in post-GFC, so we're still gaining momentum. So private credit generally in Europe still has more growth to do relative to the US. You can think of it maybe on a convergence basis, but we look at it country by country wise. So if we were having this discussion, say 5 years ago, I would say most, maybe 70% of the origination efforts that I'm seeing, they're coming from the UK. We then saw France really gaining momentum up behind it, driven by better, you know, lending environment, better documentation, better structuring. And last three to 4 years, specifically Germany, Benelux coming on. We're seeing more momentum and improvements in the further peripheral countries. So we see Italy and Spain coming more on board. And so keeping a watchful eye on how things progress there.
All right, thanks. So here in the region, we're seeing a greater awareness that bank lending, while an important source of financing for many businesses and projects, can only do so much. And I'll just give one example. So, you know, in Saudi, Vision 2030, their very ambitious plan, has an ambitious goal of significantly raising the contribution of small and medium-sized enterprises, or SMEs, their contribution to GDP. As a result, there's a growing awareness that private credit needs to fill the financing gap that banks can't cover. So I'd like each of our panelists to give examples of where their firms are providing innovative finance solutions in the areas in which they're located that go beyond traditional bank lending. And let's start with the U.S. first this time. Zia, let me come to you. You know, both you and Michael mentioned, you know, the U.S. is becoming sort of too efficient in some areas, but there's still opportunities in others. You mentioned this generational wealth transfer that we're seeing from family-owned businesses. It's in the trillions of dollars that's going to be there. Sort of where are some ways in which you'll be able to provide some innovative financing solutions?
Yeah, so again, in the market that we operate in, which is kind of the sub 35 million EBITDA, there's a lot of opportunity. Now, the key for us is you have to build an engine, you have to build a factory to source the deal flow, underwrite it, monitor it. It's a heavy labor-intensive type business. So we manage 20 billion and have about 280 people. So people look at us and say, well, why do you have so many people? It's a very different type of investing. So for us, we look at our core competencies and we say, listen, we understand inefficient markets. We have strong originations. We have deep underwriting and fundamental due diligence and underwriting portfolio management. So where can we apply that skill set? So if you look at kind of how we've built out the firm, we have a venture debt platform. So that is a highly inefficient market. You can get paid a premium if you know what you're doing. Their losses are not as bad as people perceive. So this idea of perceived risk is something we really lean into, because when you peel back the onion, you can understand, mitigate a lot of the things that people think are risky. And at the end of the day, what we're trying to do is achieve a risk-adjusted return. It's not a riskless return. So what we'll try to do is make sure we understand the risk. So we have a venture debt strategy. We have a software lending strategy. So that's software companies that trade based on a multiple of recurring revenue. Again, a little bit more complex than the plain vanilla cash flow lending. We have an alternative credit business that looks more at asset-based financing. And then we have a middle market CLO business. So when I look at kind of what we do, the opportunity set is, yes, banks are in the market, but in the US, most banks, A, are risk averse, B, have a significant capital charge to do cash flow lending. So what are they interested in? They're interested in the deposits, the treasury management. They'll do some receivable inventory, maybe a little real estate, but they're not really wanting to do cash flow lending. So, but they are relationship driven. So the way the banking system in the US works is Michael may be my banker, and I go to him as a customer and I say, Michael, I'm going to buy my competitor. I need 4 times leverage. He has one of 2 choices. He says, Zia, I love you, which he will say, but he'll say, I can't do that. And then he loses that relationship, right? So that's not a great outcome for him. The other alternative, he says, listen, I know somebody, another private credit lender, they'll let me maintain the deposits, the relationship, the revolver, and they'll do the cash flow piece, and then we'll have an intercreditor agreement, and we can work together. So now you've given them a solution. So we are very synergistic with banks. Now, if a bank and us are at a table at the same time, one of us is probably at the wrong meeting because bank pricing's at SOFR 300, 400, whatever it is, and then ours is a little bit higher. So there is a role for each of this, and it's not a winner-take-all game. So you just have to find the 40, 50 opportunities in the market where you can play the seams, and I try to describe kind of the opportunity set and at least how we see it in the U.S.
And not to agree again with my co-panelists, but I think where we focus are on segments of the market that still offer a complexity premium, as opposed to illiquidity discount. And it's the same similar business that you guys do. We focus on only certain sectors in cash flow lending because there are less competitors. We focus on asset-based lending, whether it's equipment, receivables, inventory. We finance life science companies. We're looking for those same seams. And the other thing is that, about your comment about the banks, I think the number is there's $580 billion of criticized assets on bank balance sheets. And for those of you who are not informed, when a bank gets a criticized asset, they basically want to get rid of it because the cost of capital to hold it is too long. It doesn't mean they're bad loans or they're not going to repay themselves. It means the documentation may not be great. It's not rated. Those are great companies for people like us to finance. We may say, yes, you're a criticized asset by the Fed, but you happen to have investment-grade receivables. We'll finance your investment-grade receivables even if the local bank won't, and the bank can still have the cash management. So I think as we think about kind of taking that to other regions, I think asset-based lending is kind of the easiest way for people to enter the market because it's easier to finance hard asset values and liquidation values of assets than speculative cash flows. That said, in order to be an effective asset-based lender, we rely an awful lot on documentation and borrowing base and rule of law. So the rule of law has to be there that those lenders can protect their creditors' rights if need be.
Yeah, so
sorry, and the one thing I'll add is banks are, for the most part, not as flexible as private credit. So the question I get asked quite a bit is, hey, will the banks ever come back into the market? It's highly unlikely. It's possible, maybe at the upper end of the market, but fundamentally, number one, post-GFC, all the people who did this kind of lending left. And guess what? They started private credit shops. So they would have to go and bring them back. But it's highly unlikely that the banks are going to get, I mean, even with Trump coming in and talk about deregulation, generally speaking, I just don't see that happening on the margin. It may happen on the margin, sorry, but it's not changing because fundamentally, private credit is a way more flexible solution than going through a bank because ultimately a private equity firm, if they're buying a company, they want to see who's making the decisions. In a bank, well, I got to go talk to that. You don't know who's behind the curtain. So in a private credit, there's a lot more transparency on the counterparty, and there is a premium that private equity folks will absolutely pay now that they have experienced it. Prior, they may have dealing with a bank, but there is a comfort and an ease factor that I don't think you can get from a bank.
Yeah, so Orla, where are you seeing flexible solutions?
I was just going to comment here from the European side, would agree with a huge amount of what you've said, specifically around the flexibility that the non-banks can provide. And so, focusing on where we focus, which is predominantly sponsor-backed, middle market, plain vanilla, direct lending to good companies on a pan-European basis. Those sponsors are looking for a financing partner. They're not looking to go for a one-off, one and done. They're looking for someone they can go to at the initial output, that they can get a quick response from, someone who can be flexible and thoughtful around what that capital structure looks like. Now, what we focus on predominantly, like I mentioned, it's that first lien, senior secured, not too many bells and whistles. We have separate buckets for things that are a bit more flavorsome, but just the core part of the business that I'm part of is very much that core middle market lending. And what they want to do is they're looking to grow themselves. That's the whole thesis behind the private equity business model. And so what you're looking at there is you're looking at add-ons. You're looking at somebody coming back to you 3, 6, 9, 12 months after the initial financing agreement saying, by the way, I've got this opportunity and this one. What do you think? And how quick can you be to re-underwrite that and to turn it around? And do you have dedicated teams to do that? And the final thing I'd say on it is, for those financing providers in Europe, those capital solutions providers, those private credit facilitators, you've got to find those, if I'm a sponsor, find those who have something of a permanency of capital base to lend from. So not those who are living maybe from commingled fund to commingled fundraise, or maybe some version of a semi-liquid, but something beyond that. So for us, particularly having the insurance parent is something that means that for our sponsors that we work with, when they come back to us, they know that we are always in market. We're not dipping in and out. Last thing I would say, actually, just on that upper mid-market space, we see it, we watch it, it is evolving, it is a thing, more so in the US, I think, than Europe. Again, we tend to lag behind somewhat. There we are seeing the banks dipping back in, coming in and out, I think, and I think we'll maybe continue to see that. So for us, we're watching it, we see it, but just maintaining focus on that core mid-market segment is what we're looking to do going into next year.
Yeah, so Sandeep, let me pick up on what Orla was saying there about it's not just a one-off financing, it's being thoughtful about the capital structure and being there long-term. You have a way of phrasing it. You say, we're not doing a trade, we're doing something else. Talk to us about that.
So, in all parts of, what I hear from whether it's US or Europe, and more true for Asia, is we are not there to just do a trade, we are there to build a business, right? And as Orla said, right, you can't be there only for a phase, go out, step back in the market. You have to have a long-term conviction about the market, about those businesses, stay close to the fundamentals. That's very important because end of the day, we are all credit investors. So we should be trying to make equity-like returns on a credit instrument rather than making a credit-like returns on an equity instrument, which is what happens when we do the analysis in a wrong way and step into the complexity in an area where we should not. So that's very important. And second part, which Zia mentioned a little bit, is about building long-term relationships there, right? It's about following those same businesses, following those companies for a really long number of years, right? So we are there present in Asia for the last 20 years, have feet on the ground in major countries, where it's important to build those relationships with the same founders, same families, same sponsors over a period of number of years, see their businesses evolve, what they have done right, what they have done wrong. You kind of follow that story, do repeat transactions with the same guys, and that's the best part you can do about this business is, it's a relationship-driven business. And if you can keep those fundamentals intact, that's a success formula.
Yeah. So Michael, one of the trends that you've been following is the retailization of some parts of credit as retail investors start getting interested in this stuff, right? It's traditionally been a sophisticated institutional market. Explain what this is and how market participants are responding to this.
Great question. And it's had actually, I think, a dramatic impact on the private credit world. What he's referring to is essentially there's been a creation of products, primarily non-traded BDC, that has allowed non-accredited investors, meaning pretty much any investor who have access to, which on one hand is wonderful. So democratization of capital, retail investors can have access to what in theory institutions are investing in the private credit arena. These are done in vehicles that offer limited liquidity, if you will, typically 5% per quarter if there's ever a need. But the impact of that is it's really changed the private credit market in a material way. Without naming names, one of our competitors, 5 years ago, the average EBITDA of their portfolio companies was $100 million. At $100 million, you are firmly in the middle market. At 5 times leverage, 6 times leverage, you're still too small to go to the syndicated loan market. Fast forward today, because of the retail capital they've raised, their average EBITDA is $330 million. So it's increased threefold in 4 to 5 years. The raising of that capital has changed that firm's investment strategy. They no longer are playing in the traditional middle market. They are on the cusp, or actually firmly in the syndicated loan market. Well, on the one hand, this is a wonderful opportunity during the golden age of private credit last year, because there was a need by the private equity community to do the $1 billion, $2 billion, $3 billion facilities, because the bank market had shut down. The CLR market was closed. And so they were able to put on loans at 12 to 13%. The issue with floating rate loans in our space is they are generally have no call protection. So lo and behold, we're back in a world today in 2021 where the syndicated loan market has returned to its previous levels. So those loans that were being done at 650 over have been all been repriced to 400, 375, 425, 450 over. And what's happened is, rather than allowing those repriced loans going to the syndicated loan market, they've kept the loans. And they've kept the loans because these structures are akin to like mutual funds. Money always has to be invested. You have to create the yield for your investor. And so my belief is you're going to see the returns of those larger players approach those of the syndicated loan market. We entered an era where there's become a diseconomies of scale. These structures are such that you can take in money on a daily, weekly, monthly basis, but you have to turn around and invest it. One of the beauties, in theory, of the private asset space, whether it's private equity or private credit, was that historically these were all done in drawdown structures, which gave the asset manager the ability to judge the market environment and decide when the right time to invest is. With these new structures, which are only 4 or 5 years old, you've taken to use an American term, you've taken the bat out of the player's hand. Because when that money comes in, no matter how good or bad the marketplace is, they have to reinvest. It's not to say that all of these BD structures are bad. I personally think that those structures that are kind of a single product structure, where you only have the ability to invest in kind of one asset class, are challenging and will challenge returns. If you were to be able to invest in a product that offered multi-strategy approaches to credit to allow you to pivot amongst different markets, you'd have a different outcome.
Yeah, so Zia, Michael mentioned the business development BDC structure in the US, right? So for those of you not familiar, BDCs, business development companies in the US, are a particular type of regulated entity. It's akin to a closed-end fund that has special benefits of it has less reporting requirements. They can sell to retail investors, but there's certain obligations to invest in certain smaller companies, and what you're saying is that they're kind of moving up that scale on, it was intended as a way to let retail investors effectively get into investing in smaller private companies by Congress. Recently, they increased the ability to use leverage in these structures, and so more and more folks are getting in it, and you're talking about some of the potential downsides. Right. So I'd love your perspective on BDCs or if you see retailization and other.
So I agree again with what Michael's saying. You have to understand.
Well, we're supposed to get you. We got to find someone to agree with.
Don't worry.
Yeah.
I'm passive aggressive. That's not it. But here's the issue. If you look at, and the latest stats I saw was there's 6% penetration in alts in the retail channel. So everything is right, but I get why people are doing it. When you have 6% penetration and you have 401ks and you have non-institutional investors, there's a huge demand for it, which is where this is a gold rush. Now, what ends up happening is there's a tremendous amount of money, tremendous amount of resources, and so now what do you get? I don't know if you get anything special as you get larger. As you scale, the industry, in my opinion, is getting to, or will reach a point where it becomes ETF'd, right? So right now what you see in the market are fees driven by very large LPs and allocators that very low management fees, no performance fees, very low performance fees. And it's odd to me because if I'm on an allocator's point of view, do I really want a manager that's willing to not take a performance fee and be like 30, 40 basis points? Because at the end of the day, then what difference does performance make? So then you become kind of truly a beta player, and then why are you paying a manager? So, you know, you start asking some strange questions and keeping yourself up at night. So the retail is a real thing. I think there's a lot of runway ahead because it's so lowly penetrated. And folks are just at the beginning of the adventure. You go to the RIAs, they have no idea of kind of what it's out there. On an earlier panel, they said 60-40. It is a huge education process to tell them what even private credit is and, you know, how that works and what the risks are and all that stuff. But at the end of the day, the fundamental difference is economics. The retail investor pays more. Why? Because they're just newer to the game and they have advisors, and so that's why everyone is chasing it and they're under allocated to it. So when will it change? Who knows? But I do think at 6%, it's probably a little bit of time.
I would add two things to that. One is if you look at the investments that are in these products, they are not investments that carry a complexity premium. These are syndicated, not syndicated, these are directly originated loans, but for larger private equity sponsors in general. The other thing I would add also, which is a nuance that I'm not sure is fully yet recognized, back to your point about these are 40 Act regulated businesses. I've been a manager of a public BDC since my days at Apollo, so I've been doing this for a long time. When you're regulated by the 40 Act.
So the 40 Act being the Investment Company Act of 1940 in the United States, yeah.
You are mandated to have a co-investment strategy when you're doing the same loans. And so the loans that are going into these retail products are the same loans that are going into the commingled institutional funds. You can't say, well, this loan's good for my institution, but I'm going to take the poor loans and put in my retail funds. So you're going to see retail returns come down, but it's going to have a cascading effect into the institutional market as well, since those same loans are going to be originated and put into the commingled vehicles.
Oh, interesting. Yeah. So, Orla, retailization in Europe,
Yes.
and are you as optimistic as these two are on
Well, I'll try to be somewhat controversial, but maybe not. So again, you know, staying with the same theme, what happens in the U.S. generally does eventually come to Europe in some way, shape, or form. And again, the demand there for access to private credit, so that's access to direct lending, predominantly driven by, we call them, you know, retail investors, and you know, maybe that's a bit of an overstatement, in particular on the European side. But there are various vehicles, not dissimilar to BDCs, that are up and running here, and various states of play in terms of who's coming to market with them and who's managing to scale. But again, the challenge with these is, and it really comes down to this, when you have the potential to raise such significant capital in these semi-liquids, how do you actually get that capital at work? How does the deployment work? And so what you absolutely cannot have, which I think we've mentioned we can have on the commingled fund, is that J-curve piece. You have time, you can call capital, see the deals as they come in. The sort of winners of the performing semi-liquids in Europe will be by those managers who have the capacity and the ability and the platforms to originate sufficient volume of these loans institutionally and over time to make the diversification point. And again, you know, you'll see other managers maybe who don't have scalable teams or don't have scalable operations. Like, don't forget, these loans need to be processed. They don't just come in, you know, they have to go somewhere. You've got to have portfolio monitoring, you've got to have portfolio management, you've got to have a middle office function, you've got to have a back office function, you've got to have all of these things. And so picking managers who have that institutionalized capability will be really important. So what you're looking for, again, it's the deployment piece, it's diversification within the deployment piece, and it's the ability to actually manage all of those assets.
The other thing I'll add, just on top of that, and it's true whether you're talking about Europe or US or Asia, I think the big difference in alpha for managers is going to be their workout capability. So a lot of teams, you know, our industry is judged by our losses, right? The best I can do is get my money back, maybe some fees and interest. So collecting whatever capital on bad deals is really the key. And so looking at bad deals and everyone has them. We've been around 20 years. We've done 760 deals. Unfortunately, we've done some things that we've lost money on. But what have you learned about it? Why did it happen? That is part of the calculus. Unfortunately, at least in the U.S., the market there hasn't been that much stress in the system. COVID, in my opinion, doesn't count because when the government drops trillions of dollars from the ceiling, it's hard to see what's really happening. But to me, looking at the workout capabilities and how they've worked out or what happened on their bad deals is going to be a big difference in terms of originations and other things.
Oh, good. So, Sandeep, retailization in Asia, is a big deal?
Yeah, the flight from New York to Singapore may be 18 hours, but the product takes 18 quarters. So we are going to be a little bit away from that retail or the conversion of that product into a very retail product. So we are safe. And from our perspective, Asia is still at a very, very early stage of development of this private credit market. And that's why I feel very confident that over the next few years, we are going to see a very stable, very sensible growth, and that's, sensible is more important part of that. And Zia said rightly, the workout capabilities are very important, and, if you really see historically, very interestingly, all Asia private credit over the last 15 years was actually distress. Right. Private credit in a performing way has just started. Right. It was always distress, so that capability exists with us, and, hopefully that will, and geography-wise, Asia has built the enforcement mechanics. One of the basic principles for us in our investment philosophy is, if you can't enforce, don't invest. Right. So that's very important. In Asia, being a collection of markets, there are enough markets where we won't be able to enforce.
Oh, thanks. So as I mentioned earlier, here in the region, several countries have seen that their growing financing needs, right, have to go beyond traditional banking. The flexibility of it, the capabilities on workouts is much greater, and the customization and a number of different things. As policymakers and market participants here think about how to set up effective legal and regulatory frameworks that on the one hand protect investors, maybe retail investors or the right level for sophisticated institutional investors without stifling innovation, what are lessons in the sense of both successes that they could follow in the regions where you're active, or failures to avoid as they learn from the regions that you operate? So let's go around the world again, but let's go in the opposite direction. So Orla, what lessons, good or bad, can we learn from Europe that they can apply here in the region?
That could be applied, yeah, sure. So I suppose the first thing to mention is, people talk about the lack of regulation or private credit is unregulated. So that's probably a good place to start. I would say it really isn't. It's just not regulated in the same way as the banks are. And so a lot of that comes down to, and what we discuss about a lot internally, it's the valuation policy. Now at Barings, we've always had third-party valuations, so there's that piece. In terms of what we have to adhere to, there are very strict principles, and I think what you've seen is a galvanization, Bank of England, for example, and other regulator entities in Europe really approaching the private credit managers, requesting data and trying to understand more, systemic risks, etc. So the starting point, we are regulated, and there is high engagement with regulators. And then specifically to sort of what went wrong, I don't think too much went wrong in Europe. I think the growth has been not sort of instant. People talk about it as this new thing. Actually, it's been around for quite some time in some way, shape, or form. We really saw it in bits and pieces, smatterings just pre-GFC. Post-GFC, we saw that move into sort of mezzanine players, and I think emerging in a real and proper sort of way that we see it today, sort of 2013, 2014. That's for those who've been doing it consistently for that long. And like I mentioned at the outset, sort of that early adoption in the UK, then kind of France really moving in the last couple of years, that heavy focus on Germany and Benelux. So not too many things to point to. I think it really comes down to those who are doing it and how you're going to do it. So proceed with caution. I would say diversification is the friend. Avoid concentration. I think what we saw in Europe in terms of the earlier versions and earlier commingled funds going back, say, 7 years, really concentrated commingled funds that really were an adoption or a copy-paste method over from the private equity commingled fund structure that really don't work for what is essentially a fixed income replacement strategy. So I would say diversification is the thing to focus on.
Yeah, so Zia, what lessons, good or bad, did you learn from the US?
So you're asking if I'm in the Ministry of Private Credit, what would I do?
Yeah, exactly.
Yeah, I'm down for that. So I went to the University of Chicago, so I generally believe in efficient markets. So a lot of these things I think get cleared between LP, GP. So, as a direct lender, I have one job. My job is to give you money. Your job is to give it back to me. So once I give you money, then I've done my part of the deal. But if you can't give me back my money, then there should be framework regulation. So I would lean into, you have to have a regulatory framework that allows the lenders to either foreclose on collateral, bankruptcy, like all of this stuff. That part of the framework is key to having a successful ecosystem. Because, whether it's fees, whether it's valuations, but the LP or the GP just won't invest in you. So if you say, hey, listen, I'm going to do internal valuations once a year, somebody else is going to say, I'll do it 4 times a year with an independent valuation. So then you won't invest with them. So I'm less worried about those pieces of it. Where things fall apart, I think, is you have to have a rule of law. You have to have a framework where lenders can exercise the rights that they're owed, or else nobody has any confidence in the system. So it's easier said than done. The good news is there's a long history of established ways of doing it, so it's not that complicated. Now, given kind of the region, it'd be better to kind of have something that matches different regions within reason. You can't have each country having a separate thing because it becomes a nightmare. But if the Mid-East wants and by the way, this is where it's headed, right? Like the days of going to allocators and LPs saying, listen, give me money, the answer comes back, listen, we don't really are going to give you money. You have to set up an operation, have some sort of technology transfer, teach us how to do the business, which is totally legit because that's where the business is going and that's where the ecosystem has to go. But the framework, the regulatory framework from the policymakers has to make sure that it's at least friendly, that makes sense within common sense rules for the lenders.
Yeah, Michael, you're now the Minister of Private Credit here in the region. So what lessons can we learn?
The
from
region's
the US?
in trouble then.
Yeah.
I was going to go from a little different approach. If I was going to encourage private credit to have a greater presence, I would do 2 things. I'm not going to say I know how to do them, but one is I would create ways to encourage more private equity investment in the region. Because in general, if you think about the early days of private credit, and even today, people are more comfortable lending to sponsor-backed companies, for better or for worse. It will facilitate a flow of capital, private credit into the space. The other thing I would do is if you think about, we've talked a lot about how the retailization of capital has fueled the growth. The other thing that's fueled the growth of our space is that banks in the US are very comfortable lending against our private credit portfolios. In general, most funds are levered 1-to-1. I'm generalizing. That most of that financing comes from banks. They're not criticized assets because they're effectively investment-grade assets. I would try to encourage the local banking system here to provide credit to private credit providers. That will allow them to bring down the cost of capital and allow them to have more capital in which they can lend out.
Yeah, so we've got the banks here in the region, and they've got a bunch of loans on their balance sheet, right? And then we've talked about the fact that we still need banks in the ecosystem here, right? There's 2 ways for them to grow. One is to get more capital themselves, right? And if you look at sort of where folks want to go, that's not going to be quick enough. The other is to provide the ability for them to sell those either into the market as, either security, wrap them as securities or whatever. Any particular structures work well or not in the U.S. in terms like CLOs or mortgage-backed, those types of things?
It's all over the map. We're primarily, on balance sheet lending or SPVs, where you can, carve out a portfolio of loans and lend against it. CLO is also a great technology, but that takes a long time to build.
The big one we've seen in the U.S. is the insurance companies, which seem to have more money than God, want rated paper. And so having those securitizations, there are things called CFOs, CLOs, anything that kind of scratches their itch in terms of that, there's not an unlimited supply demand, but it's pretty close. If you can crack that nut, it's a huge opportunity.
Yeah, Sandeep, what are you seeing in the Asia region that the good, bad?
I think the lessons are, you've got to work with the regulators and the local credit ecosystem to develop that, right? So we did that, and I'll go for a very specific example where we actually, over the last 10 years, have worked very closely with the regulators in India to develop an enforcement process, right? The bankruptcy code. Yeah. And that's not just about, us using that. We hopefully never use that. It's a question of once that ecosystem exists, the credit itself become higher quality. And that's exactly what we want. And what we have seen in my personal experience is regulators are very open to talk about it because they also want this credit piece to come in from globally to their companies, their businesses, to grow those businesses. That's a very important part of the GDP growth. And they realize it. They are very, very smart people. It's a question about involving them in the whole process, taking them through the journey, and make them part of the journey. It's the fear of unknown sometimes for the regulators. And why they like or don't like a product is about because they don't understand a product and what's going on with the product and what's the intent behind that product. So if you can clear all of that, I think it's a very friendly system.
Yeah. So, all right, we just have a few minutes left in the session here. One question I always like to ask panelists in terms of involved in markets is, what keeps you up at night, right? We talked about a lot of the opportunities that are here. We had the global financial crisis, which is mentioned, where you have risk building up in the system. Credit quality wasn't what we thought. AAA didn't mean AAA, and some of the things we have. So where we are now, where the markets are, and we'll just go down the panel this way, or starting with what's the one thing that sort of keeps you up at night?
I mean, me personally up at night, it's, we have significant portfolios, very well diversified. It's that sort of black swan thing. It's, well, what's coming next? We had COVID, which, and I remember especially in the early days, it was all about information. It was like, okay, this is happening, what's going to happen? Okay, and it was us staying very close to our portcos or portfolio companies. And managing through that, and I guess that turned out well. I mean, you mentioned that you wouldn't, or someone mentioned that we wouldn't consider COVID to be a true test. You're wondering, what's coming up next, and I think the only way to protect oneself around sort of black swan, or we've seen what's happening, with government relations, etc., is to be as prepared as you can be. And I think that's the prudence piece, that's sticking to what the strategy is, that's the diversification within the portfolios, that's maintaining good dialogue. But beyond that, we'll have to see.
Yeah. Zia, what keeps you up at night?
The biggest thing that institutionally we worry about is you can't be lazy, because generally in lending, time isn't your friend. So if there's an issue, you got to deal with it up front. That's how you minimize losses. So where we spend a lot of time is it's in benign environment. It's so easy to kind of, hey, I'll get to that later. Hey, I'll talk to the CFO the next month. Hey, that quarterly report I'll look at. Like, you have to be on it. And if you're on it, then you have things that you can do earlier and you can get better outcomes and so on and so forth. So, what keeps me up at night is making sure our team is on it 24/7, because folks are paying us a management fee to be active, not to be passive. So just making sure that culture keeps running through the firm that it has been for the last 20 years.
Yeah, Michael?
I don't want to be repetitive to what he said, so let me focus on something a little different. What keeps me up at night is contagion. What I mean by that is, because some of the assets are held by retail, at the first sign of trouble, the first wave of defaults, all that liquidity coming into the sector from retail will stop, and they will look for redemptions. That could force selling, but it will definitely slow down our sector when fundamentally it probably shouldn't. The good news is I don't think there's any systemic risk in the system, because our portfolios are not very levered. The banks have been very disciplined. This is not like the great financial crisis. We had leverage upon leverage upon leverage. Portfolios are levered one to two times. The banks have never lost a penny lending money to private credit, and I don't think that'll change.
Yeah, I mean, this issue of our private credit funds systemically risky, right, has come up with regulators throughout the U.S. and Europe, throughout the world. And, Sandeep, your point of, educating regulators, that's happening in the U.S. right now with folks, is educating them. why potentially it's not systemically risky. So Sandeep,
I
bring us
echo
home here.
with-
What keeps you up at night?
Yeah, I echo with all the points. I think it's all about staying disciplined and ensuring that our teams, our analysis is all disciplined. There will be volatility, and I think more than what we have seen in the past. Equity markets, where they are from a valuation standpoint, does impact the credit markets because the businesses have access to other forms of capital, which is great, by the way, because we all, as a part of the ecosystem, help each other from a product standpoint. But I think staying disciplined on the fundamentals, staying close to that is very important.
Great. So Sandeep, Michael, Zia, Orla, thank you so much for sharing your insights with us. So thank you very much.
Thank you.
Thank you.
Thank you very much.
Thank you for joining us throughout today's program. Please join us for a networking reception happening now in the foyer. We look forward to seeing you back here for our dinner program at 7 p.m.